So we're recording. As you can see, if you're looking at the screen right now, I am not at our offices in Asheville. I am at our cabin out near Murphy, North Carolina. Asheville still doesn't have potable water, and so Melissa and I have been living out here for an extended period of time. So again, I apologize that we don't have my normal background here, but I think that won't affect anything today with the with the webinar. So let me share my screen here real quick, and we will get started. Right, normal disclaimers that you all have seen before. So our agenda is pretty much the same thing as what we normally go through. We'll talk about markets, economy, etc. Talk a little bit about portfolio construction, where we are right now with our portfolios, and we will end up with a Q&A at the end. So just a quick update on what's been going on. So, and this, of course, is for third quarter. So anything that has been happening for the last month and a half here, of course, is not going to be included in what we're talking about. But back in August, I spoke at the CPR Investment Conference in Detroit. Much of August, though, I spent working on my book, The Sustainable Investor, which is coming out, I believe, September of next year. Because of the hurricane, I did get an extension a little bit on my deadline, but that's something that I'm continuing to work on. Thank you to the folks at Wiley for giving me a little bit of a break on that. I went to the Future Proof Conference in Huntington Beach, California in September. That was the second time going out there. It's probably one of the best conferences for financial services there are. We'll continue to be attending that. Talk about Asheville in general. So Asheville continues to dig out there's really no way to sugarcoat it. Catastrophic devastation of Hurricane Helene coming through. So many people lost everything. Many people lost their lives, in fact. Having lived through it and experienced it and seeing the before and after is just crazy. Again, the city doesn't have potable water yet and probably won't until mid-December or sometime in December, according to city officials. Most of that is because the reservoir has all kinds of sediment in it, and our water treatment systems aren't set up to have as much sediment as that there is right now, because we normally have really, really good water out there. And so this is something that we're all having to deal with. The team has continued to function exceptionally well. Neil, Carey, and Rebecca have continued to do everything just like we always do. There's been some obviously inconvenience. Neil and Carey both were out of town for a little while, but working remotely. Rebecca has been in Weaverville the whole time. I know part of the time she was helping to take care of some of her elderly neighbors, so I'm sure they were grateful for that. And again, we are grateful to everybody who reached out to check in on us. And I know a lot of you made donations. On a couple of my emails I had sent out, I gave you some options and some places that we had made donations to as well. These are some photos I took from the Haywood Road Bridge, sort of a before, or at least during the flood and afterwards, just to give you some sense of perspective. I did post these on social media a few weeks ago, but it's crazy seeing the difference. If you look in the bottom left-hand corner of the left photo, you see a propane tank. That propane tank was releasing gas as we were walking on the bridge over it. You could hear it coming out. So, and that's not the only one that was happening to. More water. And I mean, looking at how high that water is relative to the building there in the middle of the screen just is amazing to me, still to this day, having seen it. So again, thanks to everybody for that. We've continued to be busy though. We've been in the news multiple times. Back in the third quarter, Inc., Financial Planning, Investment News, Investopedia, and U.S. News and World Report. And we've been even busier this quarter, which is crazy considering what's been going on. We continue to put out episodes of Dollars and Change, One that dropped this morning actually is a discussion with Melissa, my wife, of course, and I about Asheville, about Hurricane Helene, and about resilience. And so you can check that out on YouTube, on Apple Podcasts, and on Spotify if you want to listen to it, or if you want to watch it again, you can see it on YouTube. And this is a shameless plug for her, but her course, The Hidden Power of Microbes, came out on the Great Courses last week. It's a 24 episode series. It should be on their homepage still as one of the new releases, so please make sure to check that out if you are interested in learning more about microbes. As many of you know, she has PhDs in microbiology and molecular genetics, and I've also, mentioned multiple times to many of you that I definitely married up. She's much, much smarter than me, so check that out if you get a chance. So talking about markets a little bit here. So this is the last quarter. Last quarter results looked good in general. S&P was up just shy of 6%. Small caps up 9.25%. Going down the list here, all cap world index. So basically stocks worldwide were up about 6.6. Europe and other developed international up 7.25, emerging markets up 7.5, bonds up 5.2, and clean energy up 9.7. So it was nice to see a bunch of different kinds of investments up for the last quarter. This goes back for the last year. Again, we can see the S&P 500 up about 36.3. And it has been the sort of the trend that we've been seeing for quite a while now, that where clean energy has continued to lag the markets. Again, we still believe that long term that's an important theme to be investing in, but we are going to make sure that it's not going to necessarily really be a major lag on our portfolios. This is the 5 year. And we can see again, the S&P 500 is outperforming across the board again. So just general stocks, large cap in the US. And the same thing for the 10 year. Didn't get a chance to put a poll together, so I'm going to skip past this today. It appears that inflation is under control. We've consistently seen numbers coming down. That's excellent news. The Fed dropped rates by 50 basis points initially in September, and then another 25 basis points last week. We expect them to continue to lower rates. This is something we've been talking about for several months now, and it's a big reason why we've put some money into individual bonds in certain cases, or increase some of our bond allocations in our fund portfolios. And realistically, the economy just continues to roll along at a really, really good clip. When you consider where we were when inflation was so high, when you consider where we were post-pandemic, the U.S. really has been a leader from an economic perspective worldwide. And when you consider the other major economies, we've really been the one that has come out of it better than anybody else has. Price earnings ratio, the S&P 500, so valuation, the S&P is about the same as it was last quarter. But I want to keep, so we talked a little bit about earlier, you could see the S&P was outperforming. The reality is that just the top 10 stocks in the S&P, and I talked about this last quarter as well, continue to be a big reason why the S&P has performed so well. Over 1/3 of the S&P is only 10 stocks. Of course, the S&P is 500 stocks, but it is market cap weighted. So the companies that are the largest take up the biggest percentage of the index. And when we look at the PE, they tend to be trading at higher multiples. So the top 10 are trading at 30 times their earnings, while the remaining stocks are trading at actually almost half that, at 18.5. So their valuations aren't as rich as those 10 stocks. And I'll show you that list of 10 stocks in just a moment here. Another interesting thing is when you look at that top 10, you can see what kind of an impact they have on the economy in general. So they support 41% of the S&P 500's R&D. So they're putting a lot of money back into research and development. Probably a good portion of that is in things like AI. They are also making a lot of the cash, so their margins are good. Um, but again, they only have 11% of the employees relative to being 33, or what I say, almost 36% of the index in general. So per employee, they're a lot more valuable. And these are the top 10 holdings as of yesterday when I put this together. Not surprisingly, Apple, Nvidia, Microsoft, Amazon, Facebook, the two classes of Alphabet or Google, Berkshire Hathaway, Broadcom, and post-election, Tesla actually has moved back up into the top 10. So again, these stocks are having an outweighted performance on the S&P, and so we need to take any kinds of returns we see with that particular index with a bit of a grain of salt. Again, inflation is back to normal, but we do believe that it's likely that Fed will continue to lower rates. We can see where we are right now with CPI. It's back below where the average is, and much closer to where the Fed wants to see it. We can see right here that the U.S. running at about 2.4% inflation in September. Numbers haven't dropped yet for a lot of other countries, but we can see that across the board, we're seeing much, much better results. If you look at the red going back into 2022, that was 8, that was 9%, that was high inflation. We've got that back to a much, much normal level. And we can see the components of inflation here, and we can see where the negatives are. Things like core goods and energy prices have actually started to come down a little bit. Housing continues to be probably the biggest portion of inflation that we're seeing. In fact, I saw an article earlier today that in one of the probably the biggest market in the U.S., New York, prices are going back up again. And so it's an interesting dynamic that we see with inflation, but the Fed has done, I think, a decent job. They probably waited a little bit too long to start lowering rates, but in general, they've done a really good job at handling this situation. This is an interesting chart that I picked from JP Morgan. All these charts, of course, are from JP Morgan like they are every year or every quarter. But they gauged inflation uncertainty by income level. And it's interesting to see that folks who are in a lower income level are much more concerned about inflation than folks are in the $50,000 plus levels. And that's really, that's a no-brainer. But until you really see this, it really makes sense because inflation is going to impact somebody who isn't making as much money a lot harder than somebody who is making more money because they're going to have to really pinch pennies. And so, that's probably part of what we saw with the election based on some of the feedback that we've seen so far is even though the economy is cranking and is the best economy in the world, this is some of the feedback that was certainly driving people's motivations. And when we look at the share of savings, savings versus spending, so that the top 10% in terms of income, they're spending about 67%, or they're saving about 33% of their money, whereas the bottom 90% are basically spending their entire paycheck to live, to go day by day. And again, this is another motivating factor that we've probably seen in the past few weeks here. More on inflation. So inflation, again, part of what is driving and has driven it is the suppliers and global supply times, things like that. And we see that we've come down tremendously from October to well below average. And so supply chains look much more robust than they did back then. We also continue to see imports from China drop. Obviously, they picked up just a touch at the end here, but it's been really made up for with Taiwan, Korea, and Vietnam, other regional countries there, but different from China. We obviously have heard about the incoming president's intention to put tariffs on goods coming in from China. It'll be interesting to see how companies will sort of shift to either manufacturing in other locations, maybe even onshoring. We'll see what happens. I've heard stories, or I've read stories in the last week talking about two things, both of those, where companies haven't intended to onshore, but also mostly we're doing two other things. They were either moving their facilities to different locations, and a lot of companies are just buying up a ton of goods right now, so that way they don't have to worry about paying those tariffs, at least in the near term. So they're bringing in a lot of um, uh, goods that are going to have tariffs on them now, stocking them so that way they won't have to pay tariffs, at least in the near term. Love to have my random but important charts here. Housing inventories continue to be well below average. Um, so, again, we, combine that with, higher interest rates still. And, the real estate market is going to continue to be buoyed by those two, or by the lack of inventory, but sort of countered by those higher interest rates. Rental vacancies, we're below on that, which means people are moving more into the rental market. Debt service ratio is about where it's been for a while, which is considerably better than it was, going back to '07, the Great Recession, et cetera. But we have started to see delinquencies on auto and credit card come back up over the last year and a half, 2 years or so. And that is not going, and that, is probably not necessarily going to slow down. I think when we look at student loans, obviously that's part of the student loan forgiveness program. Obviously, we know that's probably going to be ending really soon as well. And when we look at the unemployment rate continues to be exceptionally low, well below average, well below the 50-year average. And so people who want to work are working at this point. We've continued to talk about bonds just about every quarter for the last year. Excuse me. We saw interest rates obviously go way up from 2021 on. And we've seen them start to come down. And this is where JP Morgan is really forecasting them over the next couple of years to get back down to the 2.9% range. Our bond model continues to be about a 4-year maturity. That's probably a little shorter than I want it to be, but I'm not able to find an appropriate fund that will take us out maybe another 3 years or so. When we rebalance again on January 2nd or 3rd, whatever the first trading day is of the year, hopefully we'll have something in place to extend that maturity a little bit. It'll be better for both interest rates, but also for potential capital gains. And when we look at how bonds have performed over the last quarter, we've seen, across the board, everything from corporate bonds to treasuries and tips, et cetera, have all been in the positive. This is the first time in a while that we've seen that. And that's because rates have not necessarily been going up as of September 30th, but anticipated going up. And as we know, as interest rates goes up, bond prices fall, and vice versa. So now as interest rates are falling, we're seeing bond prices rise. So any bonds that we've purchased over the last year or two are going to start to see some capital gains. We're going to start to see those valuations rise. It continues to be an opportunity because we still are at levels that have been higher than over the last decade or so. And so we still have an opportunity to both lock in some really good yields right now, with also the opportunity to continue to get some capital gains as interest rates drop. And we can see here that a 1% fall in interest rates on a 5-year treasury results in about 8% of capital gain, which is pretty fantastic. Likewise with aggregate, U.S. aggregate, which is basically just a mix of all kinds of bonds put together. A 1% fall on one of those is about a 10% gain. So, opportunities here will continue to fit these in where it works for clients, especially based on what your risk and return needs are. We talked about AI last quarter, so I don't necessarily want to get into it too much, but there was a really interesting chart that came up um, on JP Morgan, so I wanted to show you that. But first, this is, NVIDIA's growth over the last 10 years versus the S&P 500, which it's about basically 10 times, even actually almost 12 times as much growth over that period. And when we take a look at, this is the chart that I wanted to show you, is businesses using AI to produce goods and services. And we see how this is continuing to grow, especially in IT, in information, but everything, on down the line from education to real estate, retail, manufacturing, et cetera. AI is going to continue to be a big part of our economy going forward. And again, one of the things that I talked about last quarter was about the opportunities in biotech and drug discovery. I've changed my phraseology when it comes to climate change to instead of saying climate change, I've sort of turned it upside down and started saying the changed climate. When we talk about climate change in general, it sort of kicks that can down the road. It's something that's coming. Whereas the changed climate is something that we're dealing with right now. And we all know that we are dealing with it right now, from everything from obviously hurricanes to fires, droughts, etc. Yale Climate Connections came out with this report about a month ago. Climate change made Hurricane Helene and other 2024 disasters more damaging, scientists find. So here is some of the things that they found in that report is that hurricanes as intense as Hurricane Helene are 2.5 times more likely in our region. They would be expected to occur on average every 130 years in a pre-industrial climate, but now have a 1 in 53 chance in any given year. And so the odds of us having bad storms like that have increased exponentially. Hurricane Helene's wind speeds on the coast of Florida were about 13 miles an hour, 11% more intense due to climate change. By the way, the pictures on the left are from Asheville that I took over the last few weeks. Climate change increased Hurricane Helene's rainfall by about 10%. This level of rainfall has led to catastrophic flooding in the Appalachians, has shifted from a once in 115-year event to once in a 70-year event. So that's consistently happened there, or gotten worse. One thing that I learned is for every degree in Celsius that the climate rises, the air will hold 7% more water. And so storms are going to continue to get more intense. They're going to continue to be wetter as we go forward. And finally, high sea temperatures that fueled Hurricane Helene were 200 to 500 times more likely by climate change. And so the Gulf of Mexico that was considerably warmer for both Helene and for Milton is the thing that really intensified those storms. Consumer Reports came out with this in September, I believe. Climate change could cost each American born today $500,000. Everything from the effect on the economy to rising temperatures, etc., will put a hurt, as it says, on individuals' personal finance. $500,000 for each child born today. That is a major economic impact. I've showed this before, but I think it's an important one. This particular slide, Steve Jobs said it was their job to figure out what their customers want before they do. And in many ways, that's what we take a look at Earth Equity is doing, is we're trying to figure out where the economy is going so we can invest in what we believe are going to be the market leaders in a cleaner, more resilient, more resource efficient, and more equitable economy. He said, if Henry Ford once said, if I'd asked customers what they wanted, they would have told me a faster horse. They didn't know that they wanted a Model T, but eventually that obviously caught on. People don't know what they want until you show it to them. Our task is to read things that are not yet on the page, and that's what we see things that are on the page, but people aren't yet making moves to make them happen yet. So I'm just going to talk about the election very shortly here. I know that a lot of people have been very concerned about things. I want to show you what the iShares Global Clean Energy ETF did um, versus the S&P 500 from January 2017 through 2021. You can see that clean energy was up 306% during the first Trump administration. And this is what it's done during the Biden administration, basically just the opposite, down about 55%, while the S&P 500 has been up 60%. This was through 2 days ago. So we can't always make assumptions as to what's going to happen based on an administration that's in power. This is another article. This is an article that Axios had that talks a little bit about cars and fuel efficiency standards. So interestingly, in 1967, the Clean Air Act gave California a waiver to be able to set their own greenhouse gas emission standards, which I didn't know until I read this. In 2022, California's Air Resources Board adopted their strictest rules. Basically, they want to see zero emissions vehicles up to 35% by 2026 model year, to 100% by 2035. So that's only a decade out, basically cutting off internal combustion engine cars. The federal government does not have say in that based on the Clean Air Act. 11 states have signed on, plus Washington, D.C. So basically 40% of the nation's vehicle market has signed on to the rules that California has implemented. Now, the auto manufacturers are in a bit of a tizzy because of this, because they don't know how they're going to do it. But at the same time, it's going to be really hard for the feds to try and roll this back. Basically, what I'm saying is there are actions that are happening. This is just one example to try and make sure that the clean economy continues to move forward. This is another important statistic that came out last month as well. 96% of all new power plants in the US are carbon-free in 2024. Basically, solar, wind, and batteries are 96% of that, while fossil fuel or fossil gas and nuclear are 4%. So the utilities have signed on to this. Utilities are going to continue to implement utility scale clean energy. Another good thing going forward. Again, I didn't do polls this time. I apologize. So getting into how we invest, and you all have seen this before, skate to where the puck is going, not to where it's been. This is very similar to what Steve Jobs was saying. Excuse me. When we put together our Green Sage portfolio, these are the sectors that we are looking for. This is where we want to invest our money as a core. Clean energy, energy efficiency, batteries, making sure that water is efficiently distributed, EVs, infrastructure. And I had planned on putting a section into this webinar on infrastructure specifically, especially post-Helene, but the timing didn't work out in being able to put it in here. But let me just say, some of the things that we experienced with Helene was the cell towers went down. That was one of the biggest surprises and negative impacts that we all had to deal with. So the cell towers went down, so we couldn't call anybody. The internet went down as well, so we couldn't get online to find out what was happening. And so for as much as 2 to 3 weeks, people didn't have a good means of communicating with each other. And that's an infrastructure issue where we really need to focus on resilience. We really need to focus on hardening systems so that way when this does happen, people are still able to communicate. What we saw was something that, again, I was really surprised at the degree to which the communication systems went down, not just in Asheville where it was really hit hard, but even 2.5 hours west, which is where we are right now, out in Cherokee County, which had nowhere near the same effects that Asheville had, still didn't have cell coverage. When we went to Ingles to the grocery store when we initially got out here, they were only taking cash because they did not have a link to get on the internet to run credit cards or anything. Likewise, when we take a look at resilience and adaptation in general, in terms of water systems, in terms of electricity systems, in terms of the ability to sort of channel excess water like we saw. We're seeing things like that down in Miami whenever they have a king tide, water is coming up through the storm drains because they have nowhere for that water to go. This is the kind of infrastructure that I think is probably going to be one of the biggest investment opportunities of the next decade, maybe even more, as we start to harden and build systems that are meant to deal with being more resilient to climate change and more adaptive to climate change. Natural and organic products and services. I love my Allbirds. It's about all the shoes that I wear. Sustainable real estate. As we know, about 30% of our emissions come from the built environment. We always have a big component in information technology. It helps to foster efficiencies. Green finance, insurance. Insurance is again, I preach on this every single time I talk to folks, but insurance is so important in pricing risk and getting insurers to really integrate climate risk into their underwriting processes is only going to get more and more important. Recycling, circular economy, making sure that when we make a product that it can be torn back down into its original components and reused as well as possible. Green building, of course, and cutting edge biotech. I talk about biotechnology in terms of AI shortly earlier, but a healthier society is going to be a more sustainable society. And when we put together Green Sage, what we see is you own all the sectors of the economy except for the fossil fuel sector. The energy sector is the fossil fuel sector. Solar and wind fall under technology and industrials. But we don't put fossil fuels in there because we don't want to invest in the cause of the problem. We want to invest in the solution of the problem. Remember that sustainable investing typically is growth investing. So when investments cycle more towards value investing, which they basically cycle opposite each other, growth and value investing. Value investing tends to be more traditional companies, whereas growth investing tends to be more cutting edge companies. How are we handling the current market environment? We continue to make sure we're diversified in our stocks by domicile. So US companies, developed international, developing international, and by size. Massive companies on down to, a couple $100 million small companies. In terms of bonds, we diversify by quality, by duration, by yield, by domicile, where they're located, and focus. We do a lot of bonds that are green bonds or climate-related bonds as well. And to make sure that we have non-correlated assets, so those are assets that don't move in the same cycles as the stock and bond markets, we make sure that we also include in our fund portfolios different alternatives such as commodities or currencies or different option strategies. So our core portfolios from Green Sage, Global Equity, Aggressive, Balanced, and Conservative, these are some of the mixes that you'll see. So Green Sage is 100% stock all the time, and it's got a Riskalyze number of 85. So Riskalyze is the software we use to measure risk, both for clients, but also for our portfolios. You can sort of figure 100 being the absolute highest risk and 0 being, let's just say, burying your money in the backyard. And basically, these are designed to go down from high risk to moderate risk on down to conservative. And so we've got a little something for everybody. Sometimes we will mix these up to hit a particular Riskalyze number for somebody, but you can see the mix of stocks and bonds in these portfolios. Correlation I was talking about. It's interesting when you actually mix the alternatives. You can see this particular one that I circled has 40% stock, 30% bonds, and 30% alternatives. Relative to just a stock bond portfolio that's slightly down to the right from it. you actually get a little bit higher annualized returns, but it also lowers your volatility. So from a fiduciary perspective, it's our duty to make sure that when we're putting together a portfolio for you, that we're creating one that has the best aspects to be able to get you the best return relative to what your risk needs are, with the lowest amount of risk possible. So in the third quarter, performance met exactly what we were hoping for. Likewise, the 1 year numbers are definitely moving in the direction we want to see them in as well. As I said earlier, clean economy stocks continue their underperformance since basically 2020. Um, we did change in our fund portfolios. The clean energy fund we used, we switched to from one called Q Clean to one called Grid, which is more of a um, clean energy transition fund, which has actually performed really nicely. So I was really happy to make that transition over. Um, and of course, long-term performance is in line with what our expectations and risk models for all of the models. As always, we will make tactical changes mid-cycle if warranted, but we're going to continue for the most part to rebalance and reallocate our portfolios on a quarterly basis. Let me fix that real quick. I apologize. I obviously changed it and then didn't move the chart where it was supposed to be. There it is. Um, so the orange are different indices that we use from the All Cap World Index, the S&P 500 on down. And the funds that we use in our fund portfolios are below there. So large cap growth from Brown Advisory. When we look at the 1 year, the 5 year, the 10 years, it's performed exceptionally well relative to the S&P 500, which is its benchmark. On down, we've got small caps here. That's relative to the Russell 2000. Janus Henderson International, that is relative to EAFE, EAFE here. So you can see that that has been close to that, actually better on the 10 years. And on down the line, the numbers you see here are all Morningstar ratings. One thing that, this is the fund we switched out for, the First Trust Clean Edge Smart Grid Infrastructure Fund. We can see that we've got green on the 1 year and the 5 years, whereas QClean had red in the 1 year and the 5 years. So I was glad to make that change out. We also, in the thematic portion of the portfolio from real estate, clean energy, biotech, and water, those are areas that we believe are probably some of the biggest opportunities. So I really want to make sure we have a focus on those kinds of stocks. When I find an infrastructure fund that I'm happy with, I'll probably add an infrastructure theme as well. But I haven't found one that I like. A lot of infrastructure funds include fossil fuels or pipelines and things like that. And that's not really where we want to be investing our money, obviously. On the bond side and on the alternative side, we're using 3 bond funds right now, one from Lord Abbett, one from Calvert, and one from Federated. And this is all you can see where they've done relative to the aggregate bond index. Everything is competitive, definitely on the 1 year number here, slightly less on the third quarter, but overall we've done well. And then when it comes to alternatives, we use 3 down here as well. We don't have an index. We used to, and it stopped being published. So we can just look at numbers in general. But again, looking at since inception here, numbers continue to be good. Again, these are in there to be non-correlated assets. We can see that an asset allocation fund relative to sort of the best and worst performing different styles in a portfolio. We can see that it almost always falls somewhere in the middle here. Right now, year to date, about 12.3 for an asset allocation. This is probably about a 60% stock, 40% bond portfolio. The importance of long-term investing. I went too fast on that. We always want to talk about, over any 20-year rolling period, stocks, bonds, or a 60/40 portfolio isn't down according to JP Morgan. And even with over a 10-year period, even just a little tiny bit here on stocks. But for the most part, your volatility is going to be on the 1 year, maybe a little bit on the 5 year, but beyond that, long-term investing is what matters. Timing the market, I've shown this every quarter, but it's so important to see that, if you invested from January of 2003 through December of 2022 and just let it go in the S&P 500 that entire time, $10,000 would be worth 64. But if you missed just 10 of the best, the days, seven of the 10 best days took place in bear market. So if you missed the 10 best days in the market, you halved your return. And then that goes on down. If you miss the 60 best days, you've lost 60% of your money. So long-term investing and focus on where we're going over that period and keeping, what's the phrase? It's time in the market, not timing the market. So to summarize, as always, we're going to continue to keep a close eye on the economy, and U.S. and international politics. Obviously, there's a lot of geopolitics going on, both with Ukraine and the Middle East. Anytime or anything that we need to shift based on these things, we're going to be doing is we're going to probably have an even closer eye on what's going on with politics, with Congress, etc. So if you do see changes, that's probably going to be one of the reasons why. We're going to rebalance Green Sage on December 2nd. I'm actually working on the rebal right now and which companies are going to be in and which companies we might be moving from. As always, with the fund portfolios, we'll make tactical changes when and if it is warranted. We're grateful for your business. We've had another good year. We are finally integrated with Prime Capital Financial and very happy with the folks that were working there. So we're grateful for them. We're grateful for you and your patience as we went through our transition process. Here's a few more disclaimers for you, and we can switch to Q&A. Question was, why did clean energy rise under Trump and drop under Biden? It's a really good question. A lot of the rise that we saw actually happened during the pandemic in 2020. And so what I've hypothesized is that, potentially people were sitting at home and they were looking at their statements and they're saying, gosh, I didn't want to own Exxon. I need to own the solutions. And so we started to see more money going into clean energy end of 2019, but more into 2020. And ultimately what happened is companies became overvalued. We assumed that clean economy was just going to absolutely take off, and it didn't, because the political will wasn't necessarily there, even though during the Biden administration, we saw the Inflation Reduction Act and other legislation that really has pushed forward a cleaner economy agenda. So I don't necessarily have an answer as to why it did, other than, that was the particular timing of it. And, we can guess that it might have been just people who saw the opportunity because they finally opened their eyes and saw that, their portfolios weren't as clean as they wanted them to be. Do you have concerns about the economy related to implementing tariffs? I do a little bit, yes. As we know, tariffs aren't necessarily paid by the country that's paying them. They're ultimately paid by the consumers that are affected by them, down the supply chain line. And so we'll be keeping a close eye on that to find, where are the opportunities that, won't be as affected by potential tariffs. And, my hope is that, clearer minds may prevail and we won't see the kind of tariffs that have been threatened. So, but it's really sort of a wait and see it's a wait and see time, if you will. The markets really bumped post-election, which I was a little surprised at, but it benefited us, so we will certainly take that. But we'll be keeping a very, very close eye on what's going on in the economy, what's going on in the markets. That's what you pay us to do, and that's at the end of the day, it's what we enjoy doing. So, let's see, any other questions? We're running a little bit early today, so I'll take that. I might be able to give you 10 minutes or so of your time back for the day. Anybody else have any questions? Well, if nobody does, I want to thank everybody so much for spending a little bit of time with us this afternoon. I know I apologize for having postponed this from earlier in the month, but trying to get um, trying to get everything put together and living in different places and all the logistics that go with post Helene has been a pain, but we got it together today. Obviously, we're not where we want to be, but I think that, within the next month, 2 months, we'll be back to normal in town. So thanks to everybody who reached out. I know, again, I said a bunch of you have made donations to local charities, and we're certainly grateful for that. So, again, thank you, everybody. We're grateful for your business, and we'll see you in another 3 months. Take care.